If you're like me and planning on retiring in the future, you can't afford to choose the wrong investments. For most of us, building wealth means investing consistently over a long period of time into the right assets. In this video, we're going over 7 ETFs that in my opinion are going to make millionaires over the long term. We'll go over what the ETF's overall strategy is, its top holdings, its performance in recent years, the dividend yield, and the cost of owning the ETF. At the end of the video, I'll give you, in my opinion, who I think would benefit the most from owning each of these ETFs individually. Before we get started, remember, I'm not a financial advisor and this is not financial advice. Everyone has their own financial goals and you should absolutely seek out the help of a professional to help you get there. Our first ETF is VTI, also known as the Vanguard Total Stock Market Index Fund. This fund seeks to track the performance of the CRSP US Total Market Index, which tracks almost 100% of all the investable assets in the US market. Its top holdings are Apple, Microsoft, Amazon, Meta, Google, Tesla, Berkshire Hathaway, Nvidia, and JP Morgan. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $31,402.70, which is a 3x on your money in 10 years. Not a bad return. VTI has a dividend yield of 1.66% and an extremely low expense ratio of 0.03%. Now, some investors might want to invest in the best companies in the US stock market. Well, this brings us to our second ETF. It's called VOO. VOO is also known as the Vanguard 500 Index Fund. This stock invests in stocks in the S&P 500 Index, which are the 500 largest US companies by market cap. Its top holdings are Apple, Microsoft, Amazon, Meta, Google, Berkshire Hathaway, Tesla, Nvidia, and JP Morgan. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $32,368.35, which is again a 3x on your money in 10 years. VOO has a dividend yield of 1.69% and an extremely low expense ratio of 0.03%. So here's an important note if you're planning on owning VTI and VOO. Their holdings are extremely similar and their returns have also been very similar as well. Owning VTI gives you exposure to almost 100% of the US equity market, and owning VOO concentrates your holdings into the top 500 companies. But we have to remember that the top 500 companies in the US markets also consist of 75% of the overall market. This is something to keep in mind when you're planning out your positions and evaluating your portfolio balance. Of course, where VTI and VOO fall short is international exposure, and that's where our third ETF comes in. Our third ETF is VXUS, also known as the Vanguard Total International Stock ETF. This fund seeks to track the performance of the FTSE Global All Cap EXUS Index, which means it tracks the return of stocks of companies outside of the US. Its top holdings are Taiwan Semiconductor Manufacturing Company, Nestle, Tencent Holdings, Roche Holding, Samsung, Shell, AstraZeneca, ASML Holding, Alibaba, and Toyota. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $15,487.02. Now, I know it's not as impressive as a 3x like VTI or VOO, but some investors might want to diversify their holdings with stocks outside of the US markets. VXUS has a dividend yield of 3.09% and an expense ratio of 0.07%. So at this point, if an investor chooses VXUS, VTI, and VOO, they're pretty much exposed to almost every single market in the world. At this point, if an investor chooses VTI, VOO, and VXUX, they're pretty much exposed to the entire world market. The ETFs we'll go over next are much more targeted, as they're trying to do very specific things. Our fourth ETF is VNQ, also known as the Vanguard Real Estate Index Fund. And as you guessed by the name, this ETF focuses on giving investors exposure to real estate. This fund invests in stocks issued by real estate investment trusts or companies that purchase and manage physical property. Its top holdings are the Vanguard Real Estate Index, American Tower Corp, Prologis, Crown Castle International, Equinix, Public Storage, Digital Realty Trust, Simon Property Group, SBA Communications Corp, and Welltower Inc. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $19,711.98. VNQ has a dividend yield of 3.91% and an expense ratio of 0.12%. Our fifth ETF is the very popular SCHD, also known as the Schwab US Dividend Equity ETF. The fund's goal is to track the total return of the Dow Jones US Dividend 100 Index, which are stocks selected for their high dividend, consistency of paying those dividends, and are fundamentally sound compared to their competitors. Its top holdings are Merck, Amgen, IBM, Broadcom, Pepsi, BlackRock, Lockheed Martin, Verizon, Cisco, and Pfizer. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $34,654.76. SCHD has a dividend yield of 3.39% and an expense ratio of 0.06%. From this data alone, you can see why SCHD is so popular. Although it's a little more expensive to own than VTI and VOO, it did outperform them. This is probably because of its higher dividend yield and the effects of reinvesting reinvesting those dividends. Our sixth ETF is JEPI, also known as the JP Morgan Equity Premium Income ETF. This ETF seeks to deliver monthly distributable income and stock exposure with less volatility. Its top holdings are several options, specifically covered calls, in addition to Intuit, Microsoft, Accenture, Google, and DTE Energy. If you invested $10,000 back in May of 2020 when this ETF was first available and reinvested your dividends, your position would be worth $14,150.97. Not a bad overall return for less than 3 years. JEPI has a dividend yield of 11.68% and an expense ratio of 0.35%. JEPI works a little bit differently than all the other ETFs on this list. It's primarily focused on monthly cash flow, and one way that it generates that cash flow is by selling covered calls. If you want more on this ETF specifically, I made a video dedicated entirely to it, so check out the link in the description down below. Our seventh and final ETF is QQQ, also known as the Invesco QQQ Trust. This ETF tracks the NASDAQ 100 index, which consists of the 100 largest and most innovative non-financial companies. Its top holdings are Apple, Microsoft, Amazon, Google, Meta, Tesla, Nvidia, PayPal, and Adobe. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $42,720.23, the highest return on this list. QQQ has a dividend yield of 0.8% and an expense ratio of 0.2%. So let's wrap it all together here. If you're an investor looking for ETFs that are broadly diversified and low cost, VTI and VOO might be the best options for you. If you're looking for international exposure, VXUS might be a great place to park your money. Investors trying to get into real estate might want to consider VNQ, and if you're looking for high growth and high dividends, SCHD fits the bill. Income investors might want to consider the ETF JEPI, and investors looking to gain exposure to tech companies and innovative companies might want to go with QQQ. Obviously, no one knows what's going to happen in the future, but hopefully history will repeat itself and these ETFs will continue to go up in value. Let me know in the comment section down below if you own or plan on owning any of these ETFs in the future. Thanks for watching. Be sure to like the video, subscribe for more money, finance, and crypto content. I appreciate your time. I'll see you in the next video. Have a great day.